The market is trading quite weak right now in the afternoon. You're watching the newsroom. I'm Ajay Sharma, and there is no attempt of recovery. Well, it is something got to do with the kind of valuations we had gotten ourselves into. Something got to do with the global cues were not very supportive. The news from Fitch front on U.S. economy, and then our own weight with triggers going away. Crude coming back at 86, US yields rising, and dollar index as well. All of that making a knock on Indian emerging markets in general, and India as well. Gautam Samarth is joining us, somebody who understands macros and markets both very well, and he's joining us all the way from London. So good morning there, Gautam. Thank you very much for joining us. Good day to have you. Global cues and macros are giving shivers to markets across the world, and India is no different. Is it justified? Can the Fitch news, blow up into something even bigger? Or maybe we are paying too much attention to it right now?
Sure. Thanks, Ajay. Thanks for having me on the show. I think you have to contextualize what's happening today versus, how we've got to this point. We've had a pretty strong and resilient global equity market so far this year. And I think the Fitch news in and of itself, I think Janet Yellen was out speaking yesterday in terms of what the impact actually is. The timing is a bit interesting, to say the least. And actually, it's still very much investment grade. Fitch is just trying to appear to do their job. Does it actually affect the US's ability to repay its debt? Not materially, but they're acknowledging that these debt standoffs are becoming more and more common. And so they're just trying to do their job. Does it really affect the fundamentals? No, it doesn't. I think given where prices got to in equity markets, any piece of nervousness was something that the markets are going to hold on to. And so I wouldn't read too much more into that than it's just a moment for pause in the markets, and they're latching onto that narrative in order to explain that pause in markets.
Right. Also, I was just reading just a while back, Bank of America turned out to be the first major global bank to reverse their call as far as US economy is concerned. They believe that it may not head into a recession anymore. This on the back of just last week we heard Fed Chairman Powell also say that they do not expect a major recession anymore. So calls are only getting louder that the crash landing of US economy may not happen. Now this may be actually good news for the world. How do you see it, and what implications does it have a much more resilient US economy for at a time when all the indicators of inflation have kind of turned? Is it good news for investors across the world?
Yeah, I think a lot of what you're seeing now is just a reflection of how wrong strategists have been this year. So if you take, this year has been monumentally surprising. If you think about where we started off the year, different strategists were calling for recessions with almost 100% certainty that they were going to happen in Europe and the US in the first half of this year. Everybody was very bearish. Now, you can understand why they were bearish, because last year was a bit of a bloodbath for all asset classes, really. Bonds and stocks were down 20% globally, right? And so on the back of that, sentiment wasn't great. Interest rates had tightened, and people expected that the impacts of this interest rate tightening of about 500 basis points was going to feed through to the real economy and cause recessions. And the surprising piece has been that the economies have been in the Western world and most of the globe actually very resilient. They've been able to absorb these interest rates so far and carry on. And you've seen this sort of shift from the manufacturing strength that we saw in the post-COVID era. That's handed over to the service sector. And alongside all of that, the labor markets have been very strong. So you're looking at unemployment rates in the US right now at 3.6%. The last time they were at these levels were in the late 1960s. So not in the investment career of anyone who's on Wall Street right now. And that's really caught people off guard. So what you're seeing right now by all these strategists giving up on their calls for recession, alongside upgrading their target prices for the S&P 500, is more of a reaction to how wrong they've been, rather than any sort of changing view of what the impact could or could not have been. The reality is monetary policy works with long lags, variable lags, and we might just be on the verge of seeing those lags feed through to the economy. So I don't think that the change in strategist calls has anything to do with what their beliefs were. They've just been so shocked by how resilient the markets have been thus far.
Gautam, what's your own portfolio positioning right now for emerging markets and also markets like India?
Sure. So we run tactical asset allocation portfolios. Our main objective is to generate absolute returns. So think of it like a hedge fund strategy. And we do that by allocating to high-level indices in the equity markets and to government bonds and FX. Those are the three main asset classes that we play in. We'll also participate in credit, but these are all high-level asset allocation calls. So within that context, we are neutral on equities. So we don't have any net long or short exposures, but within equities, we have an exposure to a diversified basket of EM and European equities, where we still see some attractive valuations. So some exposure to China, some exposure to continental Europe and the UK, and we're actually short the S&P 500. So we've got a net neutral position, but we have a relative value equity exposure within that. So we're playing sort of attractive valuations within that bucket. On the bond side, we've just increased allocation to US government bonds. What you've seen is on the back of some sort of noise and more robust economic growth numbers, bond yields have actually risen pretty significantly. So the US 30-year Treasury is over 4% yield. That's a level at which I think valuations are pretty compelling in a wide range of scenarios. And those assets actually have the characteristic of being able to diversify and protect you in case you do get the recession that everyone was calling that didn't come through. Because if the recession comes through and growth does indeed slow down, you might see central bankers actually cutting rates, in which case those long-dated US government bonds are quite an attractive asset to own. And then on the FX side, we maintain a diversified basket of primarily Eastern Europe and emerging currencies. They've got pretty attractive carry characteristics. So the yield that you get on a carry basket over there is about 12 to 13% running yield, and we think that's quite attractive, paired up against some low carry currencies like the euro, the Swiss franc, and the Japanese yen. So net neutral equities, long, some developed market government bonds, and some EM FX is kind of where we're positioned right now.
Right. All right, Gautam, we'll let you go on that one. Thanks so much for joining us on the show today.
Appreciate it.
All right.